Now, sorry for a 7-8 minutes delay. Somehow I left my connector at home. Don't worry, I'll not be showing you the screen. Just for the sake of so that we do not waste our time, I've taken this screen. Today's class, I would be talking a lot. In fact, every class I would be talking a lot only. You would be just listening to me. But today's class would be more of a understanding that what are my requirements from you, what are my requirements from you, and what you can expect from me. I'll make the framework of entire SFM today. Means what I need from you, how we'll be spending the days together. I might presume, in fact, not might, I'll presume that you have not learned anything in your foundation and the inter. Although I'll not slow down my speed, don't worry. It's not that I'll go back to the inter and foundation that let's start doing our work from there. It's not so. I'll be doing, for example, I need a standard deviation. In maybe foundation, you would have learned the formula. Objective here would be that we should be able to read that formula. In fact, entire SFM, my clear cut objective would be that we should be able to read the subject. Reading means is there are two ways of doing a subject. One is I'm cramming a formula. Second is I'm learning a formula in such a way that if I read that formula, for example, the way you read English language, I'm able to frame that formula. Today's class will more or less will help you out. Few things which I need from you. In fact, in between, I'll keep telling you what is the requirement from you, because as in when it comes to the mind, I'll keep telling you that what are the requirements from your side I need. The first and the foremost requirement is let's try to be on the time. Second important is when you're making a registers, make sure that do not make those thin registers, please. Very thin. Otherwise, you'll have an ample of a registers. The subject is vast. Maybe prima facie it looks we have a limited number of chapters, but this subject would become very vast. So make the thick registers. Third is please do not carry those calculators which you put in your pocket. For example, you go to the article ship and from there suddenly you put something inside and bring it here. So make sure that that is not something done. Carry a decent size calculator or maybe a calculator which you would be using in your exam. Because ultimate purpose is, I'm telling you very frankly, we somehow take classes as it's okay, I've taken the classes, pile up the registers, when exam comes in, I'll go for the exam. It is not so. You are trying to train your mind, hand, everything in such a way that when I go for the exams, my hand works accordingly. So calculator, please use that calculator which gives you a comfort level that the moment my hand works, I know I'm putting 2, 3 into multiply, GT, M plus, etc. Everything has to be there on that particular format. Another thing is I need you to carry maybe 4 5 different ink color pens. If you try to look at the screen, if you're able to see, the way I'll be using the different ink color pens, you should be using it. The reason of using them is because when you use these kind of color pens, the life looks slightly colorful. Otherwise, our life is black and white. You know the CA life. I don't have to tell you articleship and your foundation inter. You have spent a lot of time. Before I move forward, another thing I want to tell you is, and try when you come for the classes, try as if you're not coming for the CA classes. So generally, I've seen your faces look so dull, my energy goes down. Because I presume I'm not a chartered accountant when I'm teaching, at least. And looking at you, the energy level should be high. Because you will only push me that I'll tell you more. In fact, I'll not deviate from the subject, don't worry, and my target is very clear. Whenever I have taught in such a way, it's very clear. First and the foremost is that I have to score marks. That anyhow I cannot leave apart. Second is when I leave from here after the classes, you should be able to stand up in any number of people and talk general sense. For example, if let's suppose I say today we are here in it's 18 June Sunday evening. Markets are closed today. Tomorrow markets will open. Maybe you might see the new high tomorrow. I do not know. You might see a new high. We are only 30 points away from that. What is a new high, etc. These are not something for the sake of telling. I will be telling you. I would be telling you or talking to you everything which will matter to my subject. In between, today is I'll be talking more because I want to give you gist of the subject. During the subject, for example, if I'm doing a chapter called merger acquisition. Now let's suppose JBM Auto is acquiring SML Isuzu. That becomes part of my subject. Now what you're doing in the theory, exactly the same thing. I'll ask you, open up this paper, open up this. It's not they are acquiring it, it's a rumor in the market which came on the Friday. Just a rough subject I'm telling you, means by chance came out. JBM Auto is one of the companies. SML Isuzu is also one of the companies. Uh, I'll be talking these kind of things. For example, when I move to derivatives, I'll be talking to you derivative strategies, because without my practical, I cannot teach you the theory. Similarly, when we move to the portfolio management side, or let's suppose we move to the corporate valuations, the deals which happens. So everything I would be talking to you. But yes, to the relevant to my subject, you have to also make sure that whatever name of a company I take in the class, I'm saying it very frankly and very clearly, please, I'll take n number of names of the companies for the educational purpose. Please do not go back home and try investing in that. Please do not do that. It's only for the purpose of educational, because my subject is half hearted if I do not speak about those kind of companies. Today itself you'll come to know. Maybe you are seeing very basic terms here. Don't worry on that. Do not look at the screen at all, please. So you will be surprised to know that subject is such a beautifully framed that some of the chapter itself can become a career option for you. But for that you have to fall in love with the subject. Another important part before I move forward and speak to you is, please do not assume some of your seniors might have told you this is a mathematical subject. It's not so. Mathematics is required. Without mathematics we cannot do. And I'm saying it again, I would be able to read on that part. So that is also another part which comes out. uh, I told you about the books in fact will be available to you by tomorrow. I think they would have come. Maybe today if they come they'll give it to you, else today we don't require the books at all. It will take you approximately 3-4 days time to adapt. Adapt means, maybe some of you are seeing me for the first time. So generally maybe you'll see today, you might have come on the time how he looks like, the fat thin, how he talks, how he walks, etc. So there is a some kind of anxiety level amongst you. So maybe 2-3 days time, give it to me. Maybe I speak English, you will find that yes, speed can be slightly fast, slow, etc. After a 4 days time we both will be comfortable to you. Means you will be comfortable to me, I'll be comfortable to you. It's initial days, and if it's your first subject, then certainly you will find some slow, but some kind of a time you'll require to adapt. If you would have already taken any of these subjects earlier, maybe the FR or any other subject, then you would know how the subjects of the finals are built up. But generally I presume that subject basically would help you out in building your framework for rest of the subjects. So it's beautifully framed subject. Now coming back to the SFM, it's a 100 marks paper. In fact, not to spend so much of a time today itself that what which chapter question comes from, theory comes from, practical comes from. As and when we move, I'll keep telling you. For example, when I'll start the chapter, I'll tell you the approximate weightage of this chapter is maybe 8 to 10 marks and so on. Also I'll keep myself that flow of the chapters, because once I would know that yes, you are on perfect right track, then accordingly I'll keep picking up the chapters, and I'll pick up the chapters in such a way that which makes a combo. For example, if corporate valuation M&A are in link, we'll pick up there. Then derivative forex, let's suppose, because there would be some part of the forex and derivatives combined, so we can pick up as a lot, so I'll pick up accordingly. You do not have to worry on that front. You just have to present here, that's it, nothing else. And just carry yourself. Any kind of a doubt which comes in, my presumption is any kind of a doubt comes in, since you're facing me face to face, those who are looking at home, they can be in touch with over the phone or WhatsApp. For you it's very important that at the end of the class itself, please clear it, so that you do not carry back home, because hardly you'll get time today, because it's a regular classes. So today you go back home, maybe if you're going for articleship, hardly you will get time in the articleship to uh, follow up. So finish it off here, because over the period of a time the work would keep coming to you. That's fine. Now uh, my connector is somehow is not there, the pad in which I write. So for the just for maybe 10-15 minutes, by the time the connector comes in, I'll start from here itself. After that, what I'll do is, I'll start writing. So without wasting time, I thought it would be of no use to waste time, and we can talk on the basic terms of the interlevel. Now just write down the heading as introduction, and write down the heading as terms to remember, please. Don't worry, I'll be writing everything for you. It's only that somehow connector was not there, so I've shifted my work here. Just write down the term as only write introduction and terms to remember. Do not write anything. I'll keep telling you when to write and what to write, please. Okay, one more thing before we move forward. When you open up your registers, you can number the page numbers 1, 2, 3, 4 if you have a habit. The reason of it is when you will get the books, for example, you have, let's suppose we are doing something from the mutual fund. 10th question in on which page I have done, I can write in front of that page that it's done on the page number 7 of the register, so that you are able to link out. One more thing, classes would be entirely English. I would not use maybe a minimum of the minimum word in Hindi. I'll not use that. Some of the stories which I have to build up, I have learned over the period of a time how to make them in English. If, for example, a Bahubali, for example, if that's not a story, I'll tell you, don't worry. If, for example, it comes in my subject, now I'll try to picturize or speak in English. Although Telugu Radu, Telugu is, I try learning a lot, but it has not come yet. So I'll speak in English. Hindi I'll not use. And if you have to convey anything, if you know Hindi, you can communicate at the end of the class. The first is, it's a terms to remember. Now do not write anything. When I'll tell you, then only write. Terms to remember is the heading we have. First and the very important term, although you might look that it's a very easy, sir, we have done earning per share ample. It's a earning per share. Do not write please as of now. It's a earning per share. From the ratios chapter, intra I picked it up, earning per share. Maybe in accounts you would be doing it. First and the very important part, learn here please. When we'll talk about equity, or let's suppose shareholders fund, etc., we would maybe only talking about equity shareholders. Preference shareholders are considered as a debt. In the inter, there used to be formula shareholders fund, equity shareholders fund, and so on, and used to treat accordingly. When we are talking a general term, when you move into the market side, for example, when you speak to someone practically, or when question comes in, although question would clearly define, preference shares would be hardly used anywhere. If they are used, he is accordingly defined. But practically, whenever the term comes, let's suppose equity, or we are talking about the owners of the company or shareholders, they will only talk about equity shareholders. That's the equity shareholders they'll talk about. Earning per share is the earning in the rupee term for only for equity shareholders. Second important part is what you call number of equity shares. Practically, we call that as a shares outstanding. Shares outstanding in how many number of equity shares are present in the what you called the issued, for example, number of equity shares. The technical term throughout from here would be used as shares outstanding. What are these? So that's a earning per share, a very very important term. Second important term before we start writing is the dividend per share. Dividend also, when we'll talk, it will be only with respect to equity shareholders, because you might have a doubt, sir, it's a preference shareholders also get dividend. They get a fixed rate that we considered as good as a debt. So in the case of the dividend, dividend per share would be only for equity shareholders. Now two terms when I combine together, you might look at their through a general formula. Even if we do not write, we remember. I know you would remember, but you will be surprised to know when I'll move to some of the chapters, looking at the earning and looking at the dividend, you would be able to make a sense out of it whether it's a growing company or whether it's a saturated company. That means, for example, if I am a company, practically I'm earning 100 rupees, let's suppose, as a earning 100 rupees as a EPS is there, earning per share, but I pay up only 2 rupees as a dividend. From prima facie shareholders point of view, it might appear to you you earn so much but distribute only the 22 rupees out of the 100. The reason is they retain so much because there is a growth involved. So that is the objective of the earning per share dividend payout ratio. If I look at different economies, let's suppose I'm looking at an Indian economy or a US economy, you will find Indian economies are a growing economies. Companies in the Indian economies are a growing companies. So you'll find retention would be higher. That means dividend per share or dividend payout. Another issue will come after that. That payout would be a lower side maybe, and retention would be higher. In India also we can look at different sectors. Means we can have a IT sector, we can have a manufacturing sector, we can have a cement steel sector. Amongst those sectors also we'll find that by looking out some of these ratios, I can make out which are the companies which have a growth opportunities, which are the companies which do not have a growth opportunities. Certainly in exam they will not put you that, oh, find out which is a growth company, but in question they'll write the company is expected to grow. etc. You'll be able to make a sense out of that question that the payout would be on what side, a higher or lower side. That would give you a comfort level. That is what it comes in. Just give me a minute, sir. Do we have? The screen is freeze for 2 minutes. I'll just, we have got the connector. We'll connect it and we'll move. Just give me 2 minutes time, please. It's on. Just give me a single minute time, please. Connector is on. Fine. Hmm? Now, along with me, you can keep writing. He's doing his setting. Let him do. Terms to remember. What is this coming? Are you able to read what I've written? My writing is good enough because anyhow I'm married and I do not have to write love letters. So considering that, my writing is good enough. We have first term, earning per share, EPS. I'll be slightly on the slower side today, tomorrow, and maybe a couple of days. Once you'll get habit of understanding, because somehow you'll have to understand the bhavna also. Uh, Bhavna is a feeling. Means, sometime we do not speak, and by looking at me and you, I can make out what you want to say. Once you start understanding that, that connection comes in, will be very comfortable in the subject. So, over the period, try to adapt to that. Earning per share, please. The earning per share formula is, you tell me. You have to speak also profit for, and be specific, profit for equity shareholders, only equity shareholders. Profit for equity shareholders divided by number of share outstanding. You can do, I write here number of equity shares, and the equity shares, it's not a divide, its number of equity share would be shares outstanding. Shares outstanding. Second term, please write down. Dividend per share. DPS. Dividend per share. It's total dividend for total dividend for equity shareholders divided by shares outstanding. We'll write third and fourth formula also, then I'll come back to the practical side of it. That if I try to visualize these formulas, how exactly they appear. Third formula, write down please. A very, very important formula. Maybe you'll find it to be basic formula, but a very, very important formula from the analysis point of view. Dividend payout ratio. Dividend payout ratio. Dividend payout ratio. Formula, it's okay. Anyone who can remember the formula? DPS? DPS divided by EPS. Now try to read this formula. If you have to explain someone, let's suppose I'm an engineer, how would you explain that formula to? Proportion of the earnings which is paid as dividend. Today's class, I'll try to read the formulas. In fact, this same sequence I'll follow in the subsequent chapters. So formula, you know it because you have to ultimately write in the exam. But the moment you speak out proportion of the earnings paid as a dividend, I would show you today itself, you'll be able to make a sense out of it without my telling you that whether company is a growing company or whether company is a saturated or a company which has an expansion potential which comes out. Let's put down, please, to read that out. Proportion of the earnings. Put down, please. Proportion of the earnings proportion of the earnings distributed distributed in the form of dividend. Formula would be DPS by EPS proportion of the earnings distributed in the form of a dividends. Next one, retention ratio. Retention ratio. Try to say in a line. How would I read that formula? Excellent. Proportion of the earnings retained in the business. Put down, please. Proportion of the earnings retained in the business. Proportion of the earnings retained in the business. Formula would be, you can write down this way also, EPS minus EPS divided by earning per share into 100. Below that, put down a note, please. Uh, Dividend payout ratio and retention ratio would form up how much? 100%. You can put down a note. Dividend payout ratio plus retention ratio. Dividend payout ratio plus retention ratio RR is equal to. Now, before I go forward and take an example, let me show you few companies. Again, I'm repeating, please, and I'll be repeating that sentence maybe n number of times during the course also. Any companies which I'll discuss, because I'll discuss n number of names. For example, today I spoke about JBM Auto. Maybe some of you would be hearing that name for the first time, unless until you are in the equity markets, or SML Isuzu. In fact, that you would be seeing every day. Goods carrier type comes in, but we do not pay attention to it. Over the years when I've been teaching, I've been taking names. Only difference comes is in the previous batches it could have been a phase 3 company, Magna Electrocast, because I'll take names of few companies which you might not have heard, which everyone have heard, it's fine. The objective would be because there is something very unique about those companies which has a link towards it. It is not the purpose of investment I'll be talking about, neither it is to show that I have a huge knowledge and I know the companies well. Because I have a very clear cut which I'll tell every class when I start my classes, that if making money was so easy in the equity markets, then certainly I would not come here on the Sunday evening and take a class. Although it's not that I do not work or I do not love it, I am a avid lover of the equity markets. Means I can speak non-stop, non-stop hours on the equity markets. But that's a different altogether. For you, the purpose is try to get so much of a knowledge that when you go somewhere, we do not sound stupid, because I've seen generally you'll find chartered accountant, he would not know about the companies. And I am telling you frankly, we certainly do not have niche over the valuation. Means certainly somehow we have do not have that inclination to know the valuation. The reason being because we work so much of the accounting that we somehow remain bound by the law. Law says this, regulation says this. But when we talk about finance, finance is beyond that. For example, if I'm standing today in 2000, this is 2023, I have to look how would I grow till 2023. So I have to check the companies which I'm standing here in 7 years, which will turn around story. And today the time has not remained so that the companies I can say invest today and leave it for your next generation. This is not the time. If you invest today, maybe after 2 years time you come back, you might not even find that name of the company, because technology is changing so fast. If the companies are not able to adapt to it, we might not stay updated on that. So, for example, AI is coming, artificial intelligence. You do not know which companies will grow and how the companies will come up. For example, just to take 30 seconds again on division from here, Suzlon, for example, it used to be darling of the markets 2010 before, and when it came new, then suddenly pile up of a debt etc. came in. And the last 20 days, I don't know what has happened. Everyone is talking about Suzlon. Again, I'm saying it's not investable because it's not for the purpose of investment. It's only that can the companies which have almost went to bankruptcy, can they be a turnaround story? Is India working on the renewable energy, in which kind of a companies comes in? Maybe if your attempt is not nearby, let's suppose, I might ask you, some of you, if you're interested to, on your own time, in your free time, do research on some companies, so that at least when you go for the interviews etc, you can speak about that. Yes, this is the sector which India is looking for, and this is how we'll grow in the next 5 10 years time. We are moving towards a 5 trillion economy. It's a huge thing. You might not be able to make a sense out of it. What it means is, it means is when the way we are standing today and where we want to go, when it happened in China, Japan or US, the equity markets grew by 7 times, 8 times, 10 times. You cannot know. But it's when I speak about the market, by the end of the class, if time permits today, or maybe next class, we'll try to freeze up every general sense today only. Although if time permits, I'll also tell you what market is, because when you say market is growing, market is going up, it is not every company is going up. It's only few of the companies is growing up, and what is taking the markets up. So by the end of today, you would be very adaptable to some of the terms which are required by the subject, plus what would be coming in the subsequent chapters. So when I talk about retention in this ratio, the India story I was telling you, I'll have to go back to some place in which I'll have to open up connection of the net. I think if I can. My God, what? No, have I done some crime by opening up? Close, please. It's not closing. Time. I have to open up a net. How do I open now? Just give me a second. Show you something on the net. How to just call. Anyhow, that's not opening. Let's do one thing. We'll, in the meantime, by the time net opens up, we'll write down one more ratio then. By the time, I want to show you some of the companies practically which are falling in this, and I would have loved that you can make out that which are the growing and which are not growing company. Let's do one thing. Let's put down. In fact, before I put down a note here, is it compulsory? I have to put in the password. I cannot close it. Hmm? That's I'm not able to open a Chrome. It's not shutting down. Just forcibly they are trying. You have to put in. You cannot do anything. Nalaik. Hmm? Nalaik. Nalaik. Don't worry. Nalaik is a love language. It's Nalaik is not a useless fellow. Please. Nalaik is I call you by love. You can call me as Mahanalaik. It's fine. No, it is not allowing me anything. What should I do? I don't want to open. Why? So anyhow, I think it will take some time before we come back. Let's do one thing. Just write down a statement below that. I'll prove that once we are able to open up a net. In fact, let's do one thing because I think it will take some time before we go to the net. Let's put on a right below that, please. Companies. Put down note. Put down note, please. Companies which have low growth. Companies which have low growth. Low growth will have high payout ratio. Companies which have low growth will have high payout ratio and low retention. Companies which have low growth will have high payout ratio and low retention. Reason being, there is no objective of saving a money, because even if I save, in fact, you should know also one thing. You as a shareholder expect two things from a company. For example, when you go for the articleship, let me take a very straightforward example. When you go for the articleship, just cleared your IPCC or Inter, very young. You come to me and sir, I want to go for articleship. The first question I ask you, how much stipend you are expecting? Stipend, sir, stipend is not important at all. Work, stipend not important. I still ask some of the students, how much stipend you are expecting? Sir, stipend is not important. We need good work. In 3, 4, 5, 7 days time, you start realizing work was not important, stipend was only important. I hope that happens ultimately. That is exactly what happens here as to me shareholder. I invested in company, I am expecting a growth, but the growth is not coming. Company is earning, growth is not coming. So I tell my company very clearly, for example, IT companies. Maybe I'm not able to open a net as of now. I'll show you that IT companies per se, this particular time I'm saying, maybe 2 years from here, that might not hold true. Today, when the US is almost in a recession or a slowdown, the European economies are in a slowdown. Major of the IT companies, TCS, Infosys, work comes from the outside India, maybe approximately 90% of the work. Now they have a major problem that growth is not there because they are not getting new contracts. Earning, they're doing decent earning, not very huge earning, they're doing the earnings. But to keep shareholders retained with them, they will have to pay a high payout ratio. Else, why would I stay with you? You are not giving me growth, means you are not giving me a learning opportunity in the articleship. You are not giving me a high stipend also. Why would I stay back with you? That is exactly a shareholder will do. If shareholder is not getting a growth in the company, if shareholder is not getting a high dividend also in a company, then he would not stick back. We find some of the PSU companies, Private companies, some of them are there. Some of the PSU companies which pay high payout, but their share price do not increase, because we learn with the time that share price increases if there is a growth opportunities in the companies. Otherwise share price might remain at the same level. Companies earn, and major of the earnings they pay as a dividend. So what we have written is companies which have a low growth will have a high payout and a low retention. If by chance the growth starts coming in, for example, we are looking as a we want to make India as a manufacturing hub now. You'll find lot of manufacturing companies would be doing aggressive capital expenditure. So they, what they earn, they put into the business. What they earn, they put it in the business. So that means they do not have, even if they earn, they will not pay you the high dividend, because they have to retain it. And ultimate, this in some of the chapters in inter also you would have done, retention is done for the purpose of the expansion. If expansion is not there, then the high payout would follow. This case will hold true if you go back home, though I'll try to show you somewhere. Once we go back to our main screen, I will be showing you that you would be able to see this kind of a opportunity of a dividend payout and so on in IT companies, that they are paying high dividend as of now to retain the shareholders. Unless and until, sir, how many months it will remain, although I cannot depict it out, but at least till October and November end, till the time we get a clarity how exactly the European market or the US market work, the payouts will remain like this, and the IT sector might not do good. After that, once things start improving, then IT is one of the sector which starts moving very quickly. So companies which have a low growth will have a high payout and low retention. Whereas, next time please, whereas companies which have, whereas companies which have high growth prospects, companies which have high growth prospects will have low payout ratio, will have low payout ratio and high retention ratio. Companies which have high growth prospects will have low payout ratio and high retention ratio. Now I have to show you this thing, because next formula, though I can dictate, you also know it, but I want you to make that formula. Now let me try once more. If we can go back, we do not have that option of closing also. Now how do we close? Hmm. Just call someone from outside. How do we close this out? The next formula, what is there? You would be able to realize that you've done in the inter level, but I want you to make it out. It's a very, very important formula. It's without showing real companies, making that formula would be as good as it's coming that formula. So, come on, we want to freeze this for a time being. Give me a time, please. Are you able to see that screen? Yes, let's see that. You will help me out. We were on these two formulas. The next fifth and sixth formula, I wanted to make it out. Just look up, please, once. I'll show you a company. You know the MRF? Have you heard the name of MRF? Look at this company, please. MRF. Look at this company, MRF. Now, first look at the price of this company. This is the first Indian company which touched rupees 1 lakh. Its per share is 1 lakh. That means stipend. How much stipend we earn? Average 5,000. No, do not worry. It's okay. Everyone knows we are from the uh, same side. 5,000. That means 20 months stipend to buy one share of it. This company. That's required. 1 lakh. I'll come back to it. It's important part. What I was showing you. Yes, I'm showing you this. Now look at the earning per share of this company. Can you see that EPS? Can you see this part? EPS. It's approximately 1924, 1900 rupees. I'll show you the payout of this company. The payout of this company is the dividend which is paid, interim dividend you would be knowing. If I take in fact final dividend also, final dividend 144, interim dividend 3 and 3. That means approximately it has paid, let's say 150 rupees. Out of 1900, how much it has paid? 150. Can you calculate roughly how much payout it becomes on your calculators, please? On your calculators, 150 divided by, you can do round of 2000 on your calculators. You are able to make out how much it pays? How much? Roughly 8%. Now let's go back. You know which sector this company is? MRF? Tires. So you would know that these companies are tire and rubber products. We also specify that company. Now when I move back, let me put, we were talking about IT company. Let's look at Infosys, Infi. Look at the earning per share of Infosys. Do not look at CEPS, please. CEPS is, it's a cash something. When we move forward, I'll speak to you. Rest of the terms avoid. Just look at EPS, 56 rupees. It's a IT company. It's a computer software consulting company. They are kind of a matured companies in India. Now, if we go back and try to look at the corporate action, you look at the interim and the final dividend, because I assume them to be both same financial year. 17.5 and 16.5. That makes out 18 plus 16, 34. How much was our EPS? 56. How much is the payout? 60%. So you should be able to make a sense out of it, that why is it so that some companies have a high payout and some companies have a low payout. If the growth opportunities are not there, then the payout would be higher. If I go to TCS would be even higher, I think, because this is the one of the slowest pace at which they are moving. It's 106. So what is TTM? TTM is trailing 12 months, means past 12 months. Every quarter company reports a result. This quarter, for example, this is, we are in June, so results of the March came out. It was full financial year basically, so that's a trailing 12 months results. It's a, the EPS is 106.87. If we go back and look at the corporate action, look at the dividend it has given. It has even distributed special dividend in the month of January, 16/1, 67. Now you can imagine someone would be giving you, for example, just to make sure that you retain with them, 67 plus 8 plus 24. That makes a huge, almost 100% it comes out. That means the companies which have the growth will be low payout, and the companies which do not have a growth will be higher payout. Now, before I move forward, next ratio which I am talking to you would be very, very interesting. Very interesting how the financial world will talk and how the chartered accountants world will talk. Let me go to MRF once again. MRF. Look at the face value of MRF. Is that clear? 10 rupees. If I try to find out in Google dividend, dividend paid by MRF, dividend rate. Let me put down this. In fact, not dividend. Now look at this, please. Look at this. Though I have not opened the full part here, just look at this part if you're able to visualize. It paid 144 as a dividend. Somewhere we saw that just now. If you look at 144, face value is 10. You know any formula which used to calculate using a face value? You know how the language would appear in the newspapers? There used to be two formulas which you might have learned. One was dividend rate and one was dividend yield. One was dividend rate and one was dividend yield. Dividend rate is accountants' language. They speak with respect to face value. 144 divided by 10 into 100. Tell me how much it comes out. 144 divided by 10 into 100. How much it comes out? 1 1440. That is the kind of a dividend which MRF paid in the terms of the accountants' language. But if, for example, if I ask you, would I be able to buy the share at 10 rupees in the market today? No. If I have to go, I would be able to buy the share at what rate? 99,980. Now let's suppose today I go and buy the share at 99,980 and I end up getting 144 rupees as a dividend. Then what is that ratio comes out? 144 divided by 99,980 into 100. How much it comes out? 0.14. That's dividend yield. Now the moment you find, because the moment you open up your newspapers or maybe any kind of language in the journals, they'll write company has declared 200% dividend, company has declared 300% dividend. This language would be with respect to face value. Please do not get mesmerized by it. Company is giving such amount of dividend. It is not, because if let's suppose I'm getting 200% dividend, then who will not buy the share in the company? Buy the share and your shares will be free. It's not so. That means what we practically look at is yield. Yield word is with respect to the market price and rate is with respect to the face value. So accounting language is face value, technical language which you use is yield. Next two ratios please write down. Very very important ratios we'll be talking again when we go forward. Fifth ratio, dividend rate. Dividend rate. Let's put down with respect to face value. With respect to face value. Dividend per share divided by face value into 100. Next ratio, dividend yield with respect to price. With respect to market price. Dividend per share price. The share price can be interchangeably used as a word. Simple price also they'll use, or they'll use market price. This can be used a word price oblique market price. Now before I move to the next ratio, very very important ratio. After this ratios, these were all your basic ratios. After this all will be a practical oriented ratios. Before I move here, let's do a very small example just so that we are able to recall the numbers what we've done till now. Let's put down example please. Let's put down example. Calculate earning per share, dividend per share. Calculate earning per share, dividend per share, dividend payout ratio, RR is retention ratio. In exam, please do not use these shortcuts because you'll have to use only once. Retention ratio, then we earned was dividend rate, dividend yield, dividend rate, and dividend yield. Let's put down, please. I'll just dictate the numbers. Put down total earnings. Put down total earnings 40 lakh. Total earnings rupees 40 lakh. Dividend paid. Dividend paid rupees 10 lakh. Shares outstanding. Shares outstanding 5 lakh. Face value. Face value rupees 10. Market price per share. Market price per share rupees 80. 8080. I'll repeat data once again. 40 lakh was your earnings. Dividend paid is 10 lakh. Shares outstanding 5 lakh. Face value 10. Market price is rupees 8. Calculate for me quickly, please. And write the formula and write so that you are able to recall the formula. The earnings was 40 lakh. Share outstanding are 5 lakh. How much rupees it comes? Is it fine? 40 by 5. How much was your dividend per share? Total dividend? 10 lakh. Shares outstanding are 5 lakh. That comes out rupees 2. Payout ratio is proportion of the earnings paid in the form of dividend. It's 2 divided by 8 into 100. And make sure I might have put into 100. In case I forgot, then you can put it up. That's fine. 2 by 8 into 100. How much it comes? 25. I hope these are the figures we are getting. Retention ratio is, you can do 100 minus 25%, or you can do is 8 you earn, 2 you distribute, divide by 8 into 100. How much it comes? 75. Total has to be 100%. Rate would be with respect to face value. So 2 divided by 10 into 100. How much do we get? 20%. And yield is with respect to market price. So it was 2 divided by how much? 2.5%. Check once. I hope you get the same numbers. These were just basic ratios. Next ratio is the one of the most important ratio throughout your SFM you would be using. Throughout your SFM you would be using that ratio. A very, 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 very important ratio. Seventh number, price earning ratio. Price earning ratio. A very, very important ratio. Price earning ratio. Formula is, sir, what? Formula is, eh? Oh my god, my presumption is right. We do not know anything from the foundation, inter, etc. Try to, by looking at the wordings of the ratio, try to create a formula. What will happen? Anyhow, you're wrong. Even if you, by chance, you are right, it's very good for you. Wrong, keep saying. For example, if I give you, you can try a number of time, tuck 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 tuck, apply, keep. It's not your pin will block, pin will not block, don't worry. And form a habit. Okay, one more thing before, because I told you I'll be expecting a lot of things from you. The face to face batch has an advantage also. I want you to speak, please. If you do not learn talking, the world is very cruel outside. And I'm saying from the heart, the world is very cruel. You know everything, but if you're not able to say, they will presume you do not know anything. So what if it's wrong? I tell you very frankly, I'm not defaming any other profession, but when I look at other profession, they hardly know 5 to 10% of what you know. Only thing is, they make it a fancy item and sell off everything. But you are not able to show what you have. Price earning ratio, for example, why I'm saying it's not about this ratio, I'm saying in general sense also. Try to speak. I'm not criticizing anyone, I'm not saying badly about anyone, but I'm trying that yes, this can happen. You can always give your opinion, and the classes are foremost thing in which you can learn this habit. Speak amongst yourself. You could be good at one subject, second one could be good at second subject. Talk amongst yourself, have debate, not a fight, have a debate, so that you know what is happening. Your learning would automatically increase. For example, if I ask you price earning ratio, some of you can say yes, EPS by price, etc. Some of you can say I do not know. Some of you can try what could be the possible way out. For example, it's a word itself, price earning ratio. So it's a price. In fact, also learn apple to apple comparison. When I have a total share outstanding, means, for example, if you look at these ratios, how these ratios were created. If you look at 40 lakh, 40 lakh was total earning. The number of shares were total. If there is a total, divide by total. If there was a per share earning, division happened by the per share dividend or per share, means, I hope you are able to make a sense out of it, please. In this case, this was per share, this was per share face value. This was 40 lakh was total, 5 lakh was total. This 2 was per share, this was per share. That means there has to be some apple to apple comparison. When I say price earning ratio, price is per share. That means earning has to be per share. Now formula, how do I create it? The moment I write price earning ratio, it has to be price by EPS. It's very price by EPS. Although formula wise, it's very simple. But I am telling you, this would be one of the most used formula throughout in different ways. Sometimes I'll calculate it, use it for the purpose of valuation. Sometimes I'll use it for the purpose of calculation of KE, which we'll see just now. Means this formula would be a very, very critical formula going forward. I want you to able to read this formula today, and maybe today is the day when you can freeze it, that after that no one should tell me what P ratio comes out. Let's put down the formula and then I'll go back to the practical example of it, please. And I want you to speak, please. It's price divided by EPS. A very, very, very important formula. If you want to put any number of star, you can put. Maybe first class you are not able to analyze it. In subsequent classes, you will be able to make a sense out of it. Now, we took the example of MRF. Let's go to the MRF. One thing we can do, you can along with me write down any company comparable to MRF, same sector. See it. That's fine. Let's put down. I put down. You can see how I'll put. You can give me a second's time, please. MRF, see it, and I need is price. I need is EPS. Is that fine? You can make this kind of a structure. Then I'll show you the data. You put down here, and then we'll come back here again. You can put down MRF, see it, price, and EPS. Can I go back? Now let's come back. Put down the price, please. 99,980. I'll copy from you later on. This is the price of MRF. Done. Then copy this EPS 1924. Do not calculate, just copy that down. See it. 2072. 2072. EPS 51. Rounding off you can do. 50.9 you can do 51. Done. Now before I go back to that screen again where you written the formula, let me put a straightforward question to you and give your first instant answer. Both are in which sector? Tires. I have to advise my client that he is asking me I need to invest in the tire sector. He's looking that since e-vehicles will come, etc., a lot of churning around will happen and so on. He gave me something and he told me, sir, advise me, Mr. Jain, advise me to invest in which of the tire companies, MRF or C8. MRF share comes from 99,980 one share. This comes, you can get 2 shares in a 1 month stipend. Do not feel bad, please. And if you feel bad, it's good that fire would come. 2072, which comes out. Your first instant answer, what advice would you give? First, C8 comes out. I mean, it's okay. MRF or C8. I have to invest in a tire company. Means one property I am getting for 50 lakhs, second property I am getting for 1.5 crores. Advise me which property should I buy? Height, width, size, everything is same. Or leave share. Let's come back to property. One property I am getting for 50 lakh. Second property I am getting for 1.5 crores. Same height, size, width, everything same. Which property would you buy? Low cost? What happened here then? I'm asking you a general common sense here. Now let me change my question. Then tell me why someone would buy MRF? Or why someone would buy that 1.5 crore property? Anything else comes to your mind? Now let me reframe in the property case example. I want to buy a property, same height, size, width. 50 lakh properties available with in to me is in Shamshabad. If anyone is hearing from outside, Shamshabad is, let's say it's a, for them, you are in Hyderabad, someone is who's looking at the recordings, for them it's a rural area. And 1.5 crore properties available to me in the Panjaguta or main hub of the city. Then you tell me, are they both comparable? Means simple words I put, same height size property, one I am getting in the village and one I am getting in the city. Do you compare? Are they comparable? No. That means my answer changes the moment I look at that valuation would change accordingly in which area I am buying. Whenever you get stuck in valuation in the finance, please take example of the property, your 99% of the valuation will be solved there. If I say buy a property in the rural area 50 lakh and buy here 1.5 crores, you cannot compare both of them because the rate of the area changes. It could be because of the locality, it could be because of the beauty or something, anything which comes out. Now that means there has to be some difference between the C8 and the MRF. If I tell you very frankly, look at face value. Face value of C8 is how much? 10. Face value of MRF was also 10. You know what is the reason behind it? It's same as, why do you buy a property? Let's suppose you are buying a share. You buy a share because share price will go or it will give you some type of income. What kind of income you expect? Dividend. Similarly, when you buy a property, for what purpose you buy a property? Rental income. Now think of a logically, in the prime area when you buy a property and same property you buy 100 kilometers from here in the rural area, will you have the same rental income? No, it means income behind a particular asset, one of the principles. Income behind a particular asset. It could be any asset, leave gold apart. Gold has something different which we'll talk when we go to the subsequent classes. Any asset when you're looking at, your first and the foremost thing should work that what kind of an income I generate from that asset. The more income I generate, the valuation would automatically be higher. Secondly, there are no two companies which are comparable altogether similarly. There could be change of a difference of the management. There could be difference of some other parameter which comes out. It means when I talk about property, I look at the rental income. If I buy a property in the Nariman Point, Mumbai, which is the most prime area, or Connaught Place of Delhi, which is the most prestigious areas of India, and I buy same here, that means my rental income would not be same. So same 1,000 square feet area here and same 1,000 square feet area, the income would change, hence the valuation would change. Similarly, in the case of these two companies, things would change. Now, from today onwards, whenever you go, please do not look at absolute prices. My objective of showing you MRF and C8 was, do not look at absolute prices. Maybe comparatively also C8 would be cheaper, but do not compare 2000 and 1 lakh. You cannot say 1 lakh is costed 2000. Then certainly you would say one of the shares we have not investable advice at all, please. One of my favorite stocks, Idea. Reason is I am using that phone for last 20 years and I'll be there till the time that company remains. I don't know why. I have certain love for it. That is trading at 7.8. Maybe today when I'm starting, it's 7. Yesterday close was 7.75. Bharti Airtel is trading at 800 and something, 20, 30 rupees and so. Both are telecom sector. One company is 7.8 and one company is at 830. Then why would someone buy Bharti and not Idea? No one would buy, because every day you will hear it will close down, it will close down. Educational purpose, again, disclaimer. Next time I'll put here only educational purpose, the line below that. Because educational purpose, I don't think Idea will close down. It will move up or not, that we'll discuss in subsequent classes. Today is not the right time. Everyone is hearing us. So the no one investors are not keen to buy Idea because of some reasons. Because of the huge debt they have. Do they have the debt or not, which we'll talk certain later. Prima facie, I'm telling you. So there has to be reason behind it. Similarly, when we look at this company, 2000 might be costly because you have to check how much is the earning behind it. Although prima facie, I can tell you MRF is only costly, but whenever you will find out that which company is costly, this ratio will tell you. How much figures you got roughly, you will help me out. Because face value both is 10, only difference is share price and the earning per share. Now help me out in writing the numbers you get here. What was the price of MRF, please? 99,980. See, it was 27872. Rounding off, I'll do. EPS 1924. This one, how much? 51. 51. Tell me the P ratio. Tell me, calculate the P ratio and tell me how much it comes out. $51.96. Can I do rounding off to 52? 52. It's a times which comes out. This is rounding off. The sign on the equal to always rounding off. Next one. 41. Approximately 41. I'll write approximately 41 times. Now let me try to read this formula. Please do not compare 99, 980, 2072. You should be able to read out the formulas now. What does it mean? Now when how to read formula, sir? What does 52 times means? There are two interpretation of 52 times. Two interpretation. One is, if the company earns 1924, let's suppose I buy today this MRF at 99,980. Assuming ceteris paribus company earns every year 1924, in how many years my money would be recovered? 51 years. That 51 represents kind of a payback period. It's kind of a payback period of your capital budgeting. Now when you look at 51, 52, sorry, 52 and 41, it means my investment in the case of MRF would be recovered in how many years? 52 years. In the C8, 41 years. Now if I ask you which company looks cheaper to you, C8, then you can take a call. It's a maybe because of some reasons that even share price is lower and its payback is also coming lower. That's one of the ways of reading it. Do not write, I'll dictate. Do not write. Second way of reading is to earn for 1924. I have to invest in MRF. You know how much rupees? 99,980. It means to earn 1 rupee. How much I need to invest? 52 rupees. That means per rupee of earning, if I want in both of them, MRF is asking for how much? 52. Whereas CAT is asking for how much? 41. That's second way of interpretation. P ratio in itself does not have any kind of a interpretation. P ratio is priced by EPS. Maybe prima facie you are able to see that ratio very easily. This ratio would be used. Sometimes they'll give you this ratio, you have to calculate price. Sometimes they'll give you this ratio, you have to calculate EPS. It's okay. But for the valuation purpose, this is the most common ratio which is used practically. I'm saying most common ratio which is used practically. Anyone who is in the stock market, you ask him prima facie which stock is cheaper and which stock is bad, he'll talk about P ratio. Then the second doubt can come is, sir, if such is the case, then why would anyone invest in the MRF? Because it is taking 52 years and second is taking 41. What we are doing is a historical check. It is not necessary that it will earn 1924 going forward. There is something called a growth opportunities. We have something ratio called PEG ratios, which we'll learn in the later part of the courses. That means growth is also attached. Management might not be same. There could be some other working which could be there. Some company might have a debt, some company might not have a debt. So there are n number of parameters. But prima facie, when you go for the interviews, anywhere when you go, he'll ask you first question that which company is cheaper and which company is expensive. You'll say lower P ratio company is cheaper. That's your first prima facie answer. Assuming rest other things are same. Then he'll say why would someone invest in the company which has a high P ratio? Then say we have to check the growth opportunities. Management difference could be there. The growth prospects could be there. Debt could be a difference because a company which has a high debt and company which has a low debt, that automatically leverage position also makes company expensive and cheaper. Attraction comes when I am investing in company which has a low debt and whose management is strong. So that could be the difference, which anyhow it's not today's task. A very important ratio. Let's put down how to read. Let's put down please along with me how to read. 52 times mean. First interpretation. If company earns if company earns rupees 1924, then recovery of recovery of investment of rupees 99,980 will be done in 52 years. This is similar to this is similar to concept of concept of payback period. This is similar to concept of payback period of capital budgeting. Second interpretation. Second interpretation. To earn rupees 1924, we need to invest rupees 99,980, comma it means earn rupee 1, we need to invest how much rupees? 50. To earn rupees 1924, we need to invest 19,980. To earn rupee 1, we need to invest 52. So below that, you can put down a note. Lower P ratio, lower P ratio is better, is better. Assuming, very, very important part, assuming all other factors, assuming all other factors are same between, are same between both the companies, which never happens. It never happens because no two companies are alike. Theoretically, we say both are alike. And if we have to move away from here, then there are something called growth opportunities and so on, which we'll look up when we move forward. But interview, he'll definitely ask you this question if you're going for any of the valuation interviews. How many ratios we have done? 7, 8. Small but very important. Again, a new terminology for you. Market capitalization. Market capitalization, also known as market cap, market cap. In rough or a general language, we call it as a market value of equity. Market value of equity. In fact, our batch has started at such a time that last this Friday or Thursday, which went just now, we have seen the highest market capitalization of BSC companies. Means the valuation was at the highest level. Market capitalization, just starting the formula, how do we calculate? Let me tell you. It's basically share price into shares outstanding. That means there are companies listed in the stock exchange, and when we multiply with their share number of equity shares, the market capitalization was at highest. And tomorrow again, I'm saying you might see a history being made. Because last time this level, in fact, Friday Nifty closed. What is Nifty? We'll speak before we end the class because that's a offbeat topic. Nifty and this Nifty closed at the all-time high. Closing was all-time high, but it has not breached all-time high. That means it went up and came down, but closing happened at a level which was highest, and it is 30-40 points away. Maybe tomorrow opening itself, it open a 50-60 points gap up, and you might see the new high tomorrow in the Nifty. But do not again get mesmerized by if Nifty goes up, your share value will also go up. The myth I'll maybe today itself I'll break, because when you look at the market, it's managed basically. For example, Nifty is all time high, but Reliance is giving you loss in the last 2 years. Some other shares have gone up, some shares have went down. That will be a different topic which comes out. This was market cap, market value 50. Ninth formula is again one of the very, 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 very important formulas. Today's task would be not learning the formula, because this formula we will learn in the chapter called portfolio management. I'll be using some statistical tools for this formula, but this term would be used. It's a beta. You might have heard this term in the IPC Center. Again, I am saying today's task is when I move to a particular chapter and doing my formulas, by that time I should be comfortable reading that terminology. Today's task would be I should be able to speak out beta. After today's class, anyone talks to you, you should be able to say what beta means is. So I'll not do mathematical calculation because it requires statistical tools which will be in a particular chapter. Today we are just learning in a general layman's language, Aam Aadmi language. Aam Aadmi. One more thing. When I say Aam Aadmi, please do not assume I am a lover of a Aam Aadmi political party. I might tell you some political events during the classes that due to these political events, BJP has done good, Congress has done good, and please do not come after the class. Sir, you love BJP, you love Congress. I do not love any political party, please. I only love my financial markets. If some action has been done by some party in favor of that, I love it. So do not make it as a BJP, Congress, or Aam Aadmi, or TRS, or Telangana government, that scenario. I'm sure, because we are a student, you only have to make a sense that what decision was taken by a particular government and what impact came on a particular sector. That's it. So that is exactly we'll be talking about. So I'm very clarifying. Please do not subdivide our class into political events. Beta, a very very important term. It's not a beta, it's a beta. B, the small, slightly bigger. How to speak that out? You know this. It's a beta. Discussion would be slightly lengthier. Before I discuss, let us talk in a general sense. I move 10 steps. She moves 12 steps. I am moving 10 steps. She is moving 12. I move 20 steps. How many steps she'll move? 10. She is moving 12 steps. I am moving 20 steps. She'll move 24. If you have to form a relationship between me and her, that means how much time she is moving? First step of mine, she is moving 1.2 times. That's fine. I am moving 10 steps, he is moving 8. I am moving 10, he is moving 8. At every 20 step, he'll move how much? 16 steps. That's fine. Relationship is zero point 0.8. I am a stock market. What is stock market? Leave the discussion for timing. I am a stock market, you are a stock. It means beta shows. Please should be able to recall back. And this example, beta shows a relationship between a return from a stock market and return from particular stock. That means if I am moving, and if I am moving 1, she is moving 1.2. If I am moving 1, he is moving 0.8. There has to be relationship between that. When the market moves, how will that particular stock move? That relationship is captured by beta. And can you feel that movement? It's a basically relationship, correlation. That means we'll be using some correlation formula over the period of a time to derive the formula. That means if I'm able to recall, it's a relationship movement between a market and the stock that captures a beta. So 1.2, 0.8, mathematical calculation, leave it. If someone says 1.2, you should be able to say market is moving by 1, the particular stock is moving by 1.2. That is what beta captures. Let's put that definition first, please. Let's put down. It shows relationship between and you put down proper words. It shows relationship between return from stock market, return from stock market and a particular stock. Return from particular stock. Now, before I write again the down forward, I move 10, she is moving 12. That means relationship of 1.2. How do I define that 1.2? If the stock market, if the stock market changes by 1 percentage, the stock will change by what? 1.2 percentage. I use the word change. You'll be able to get some hint out of the IPC also. These kind of chapters you would have done. That means it's a kind of a relationship. Leverages means it's a movement. If the stock market increases, then I am a stock market and she is a stock. If the stock market increases, the stock will increase. If the stock market decreases, it will decrease. But relationship would be 1.2 times. Movement of his was 0.8. So there could be possibilities some stocks move high also and down also further. For example, I move by 10, she is moving by 12. I decline by 10, market, she will decline by what? 12 percentage. If he is 0.8 relationship, 0.8 is I change by 1, he will change by 0.8. If I increase by 1, he will increase by only 0.8. If I decrease by 1, he will decrease by 0.8. That's basically kind of a fluctuation we are covering here. That's how it comes out. Now before you copy the below which I'm making, I'll make in such a way interpretation on the right hand side and how to read that 1.2 beta. After that I'll keep coming to the points. Copy this way please. Just give me a time before you copy. Let me look up please. It's a, for example, a beta. Please do not copy. It's 1.2 and I'll write here interpretation. Interpretation would be slightly lengthier. I'll start from here basically. You can accordingly copy. Beta 1.2, how do I read that out? Copy that part please. Beta 1.2, how do I read that out? Beta 1.2. I'm writing in front of that. If the stock market increase decrease by, if the stock market increase decrease by 10%, then this particular stock then this particular stock will increase oblique decrease, then this particular stock will increase oblique decrease by how much, sir? Well, bracket would be 10% into 1.2. The important part is if market increases, the stock increases. If market decreases, the stock decreases. It's called same direction movement. It's a same direction movement, positive beta. Second beta I'm taking 0.8. You tell me sentence. If the stock market increase decrease by 10%, then this particular stock will increase decrease by 8%. Let's put down please. Stock market this particular. Please remember it's a same side increase decrease. We call this as it's a positive beta. It's a positive beta. It's a positive beta. Same directional movement. Same direction. Sir, do we have negative beta? Theoretically, yes. Practically, no. In exam, negative beta can come. Theoretically, yes. Practically, no. Reason understand why. Beta is a relationship of a stock market and a particular stock. In a short period of a time, it might happen that a stock market will go up and your stock will go down, or stock market will go down and particular stock will go up. For example, let's suppose I have opened my shop in a mall, and mall is doing very well. There are 100 of shops, but my shop is not doing well. Maybe I'll wait for 6 months time, maybe I'll wait for 1 year time, and then I'll close my shop because my shop is not working. So long term I cannot have a relationship which is against that mall. Let's suppose that mall is in a recession and that is not doing very well for 4 5 years, but my alone shop in the 100 shop is doing well, then certainly it cannot happen because rest of the 99 are not working. It means the relationship with the particular master cannot be negative. If I'm a stock market in a particular stock, the opposite direction in a small run can be perfectly fine. In the longer run, when we say the way markets will behave, the stock will behave accordingly. It cannot have a opposite direction which happens. But in exam he can give you, because he'll give you limited data. Generally we call it that beta is a longer term relationship. When we look at the statistical tool, it's a longer term relationship. But in a short period of a time, there could be a possibility he'll give you a limited data. In that there could be negative. Practically, again, when you go for the interview, I'm very clear. Please do not, if someone says can there be negative beta, your answer has to be no sir, there cannot be a negative beta. But yes, in a very short period of a time, the movement can be opposite with respect to the stock market. There could be negative beta. Do not say it's practically the negative beta comes out, because your interview would end then and there itself. For the purpose of writing, I'm writing how negative beta. You've seen that positive beta means if market is going up, stock is going up. If the market is going down, stock will go down into multiple times of that beta which comes. Sir, how do we calculate 1.2? Again, this is not my today's discussion. I do not require it. If I say it's a negative minus 1.1, negative minus 1.1, 1.1 means is the movement would be 1.1 times. For example, I change by 10, the stock will change by 11 percentage. But if I go up, the stock will go down. If I go down market in opposite direction, that's the negative beta which comes out. In theoretical life, it can come. Let's put down please beta minus 1.1. Let's put down. If the stock market increase oblique decrease by 10 percentage, then this particular stock will increase decrease, sorry, will decrease oblique increase by 11 percentage. The objective is opposite direction, increase with decrease and decrease with increase. We call it as a negative beta, opposite direction. Negative beta, opposite direction. Theory it can come minus 1.1, opposite direction. Few very important notes below that. Again, before I dictate, let us verbally make it out. Beta shows a relationship between a stock market. Do not worry on the stock market. Definitely, depending on the time at the end of the class, I'll be able to tell you what market or stock market means. Beta shows relationship between stock market and a particular stock. Sir, what is stock market? Nifty, NSE or BSE, you can assume as a stock market. Stock is a Reliance, Infosys, TCS, Wipro. These are stock. My relationship, stock market relationship with particular stock is captured by what term? Beta. What is my relationship with me? If I move by 10 steps, how many steps I'm moving? I'm a market. What will be my relationship with me? Same. That means beta of the market would be 1. Beta of the market would be 1. Second important part. If the beta of the stock is greater than 1, if the beta of the stock is, let's suppose it's 1.2 here. That means if I move up by 10, you move by what? 12. If I go down by 10, you go down by what? 12. That means your return is also higher and loss is also what? Higher. Please understand, in a financial management, risk is fluctuation. Risk is a fluctuation. Beta captures a fluctuation. Higher the fluctuation, higher the fluctuation, higher the risk, or higher the risk means higher the beta. Although we have different parameters also of risk, since we are talking beta specifically, I'm talking about beta. It means if market are a bull run, which we are seeing over the period of time, after the COVID period, first 7-8 months were very bad for the stock market. After that, so much of a liquidity came in the market. The stocks have reached such valuation which I have not seen, or even my ancestors have not seen in their life. The valuations have reached. everything is running, everything, but it moves so quickly. For example, if you would have met me 10 days back, I could have spoken to you about one of these stocks, but that stock has already moved 50-60% by now, and I'm assuming after today also it will move another 50%, but that's subject to, again, depending on circumstances. That means market has moved by in that period around 5%, stock has moved very highly. That was a high beta stock. But if the market falls from here, that stock fall would also be what? Higher. The higher beta or a beta greater than 1, we call it as an aggressive beta. Aggressive means they are basically, for example, they get aggression very soon. In happy times, they move very quickly. In a bad time, they come down very quickly. Some of the examples could be, for example, when the economy is doing good, you know which sectors generally do good? Instead of taking a name of the companies, steel, metals, for example, cement, infra, banking, or financials. These are some of the sectors which do very good. If your economy is booming, these sectors will do very good. If your economy is doing bad, these sectors will come down very quickly. ICICI Bank, for example, or a banking sector, I'm just saying, these will come down very fast. The stocks whose beta is less than 1, that means when economy is doing very good, they will move with their own pace. If the economy is doing bad, still they will move with their own pace. Some of the examples could be FMCG goods, fast moving consumer goods, or pharma, for example. Now, pharma, for example, I'm saying is, I do, I do not go to hospital depending on, oh, economy is doing good, I am also doing good. Health issues, no health issues. Economy doing bad, health issue suddenly comes in. It never happens. You do not know, you do not fall sick or hospitalized because of the how the economy is doing. It's your health. It's stagnant. Although they also move quickly up and down. COVID came in, for example, that was a rare circumstance. That hospital sector moved up very quickly. But it is not unlike it was one of the events. Otherwise, they remain. If I'm falling sick, I'm falling sick. Means a general population. FM's Colgate, for example. Now I do brush 2 times, maybe you're doing 1 time. You cannot happen. Economy is doing good, I'll start doing 10 times. It cannot happen that you start spending on the Colgate. You will do 2 times only. Salt, that salt which comes in. Few items which you do normally, no matter what kind of conditions are there. If an ultra bad situation comes, maybe instead of 2 times, you start doing 1 time paste. That also rarely happens. So they are low beta stocks. Means they are defensive beta, we call it as. Why do we use these terms for aggressive and defensive beta, by the way? Because a portfolio manager, for you it's just an example, for a portfolio manager, when he's taking a call to invest, how would he take an investment decision? Think of a situation. He has to generate something called alpha return, means over and above the market return. Alpha is basically one of the terms we'll be using subsequent chapters again. Excess return over and above what normal person is getting. I know market is in a bull run. For example, when you go to the highways which are built, you know you can increase your speed. 60 can become up to 100 because allowed you can go. So you can cover up your time there. What they do is they invest on those particular stocks. They invest in those particular stocks which are aggressive in nature. Aggressive means which moves very quickly. Return could be higher. The moment economies are in a bad phase or slowdown phase, what they'll do is they'll start investing in a particular stocks which can make or cut down their losses. So, for example, if we come to city, we reduce our speed, we might not get accident. Exactly same way portfolio manager takes a decision. So, aggressive decision we take when we know, yes, this is the right time, jump. This is not the right time, let's be slow. Exactly, the beta concepts comes handy. If I know what is aggressive beta, what is defensive beta, I can churn out my portfolios. I can shift around my portfolio which comes. So beta of the market, my relationship with me is 1. If the beta of the if the beta of the stock is greater than 1, it is known as a high beta stock or aggressive beta stock. If the beta of the stock is less than 1, we call it as a low beta stock or a defensive beta stock. Beta is a measure of a systematic risk. So what is a systematic risk? There are two type of a risk. One is related with the system. One is a respect to particular company. For example, sometime back, Adani, in fact, that is going on. It has happened very recently. Now, that was with respect to India as a whole, or with respect to that particular companies of Adani Group. That was with respect to that companies. Slight moment came. Adani, sir? Who Adani? Adani. Your faces are appearing as if you're hearing this name for the first time. Because I start believing, English. It appears as if we are unknown to what is happening outside the CA world. No, no, it's good. For me, my work has increased. Some problem came to that particular sector. Some Hindenburg report came in and etc. That was targeted a particular group. That was with respect to that particular companies. That was called company specific risk, which we are not talking. Beta is not that. Beta is a market related risk. That means it's a macro level risk, political events, inflation, interest rates. The time you are taking the classes, it's one of the very unique time which we have not seen the last, means the history has not seen. The kind of interest rate which are appearing in the US markets, the kind of valuation which we are standing at, it's a very different altogether. So we have history being made, and I think in the next 6 months you'll see a lot of history being made. US is standing as some of the highest interest rates. So the moment interest rates changes in the US, the whole world fluctuates. The whole world. Now you would be surprised, whole world, what happens to it. Interest rate which was almost a 0% or 0.25% before COVID or around 2020, now it is reached almost 5%. So the inflation, the interest rates, political events, for example, next election will happen, BJP will win or not win, will also hamper the market. That's a systematic risk. So beta captures the systematic macroeconomic risk which captures. So that's the beta. The most important part out of the whole discussion is I should be able to speak in the layman language. If someone says what is beta, you should be able to say beta is a relationship of a return from market and a stock. If someone says 1.5, you should be able to mathematically read out. Mathematical reading is that if market changes by 1%, the stock will change by 1.5. If market increases, stock will increase. If market decreases, stock will decrease. It's a positive beta, negative is the opposite of it. Formula will come very soon. Where would be used beta, sir? We'll be using in one of the formulas called KPM, calculation of a KE method. So for that reason, I had to pick up the beta. Without beta, my almost any chapter will be non-doable. But the moment if I go and make you do the calculation of beta, your trust on the subject will go. You'll say, huh? SFM? No. My objective, I told you very clearly, fall in love with the subject. And I'm telling you, by the time you'll reach the formulas, you would have fallen in love with the subject. You'll not even realize that by doing you've learned the formula. Automatically, marks by marks, step by step will go. For some students I've seen, sir, let's start with the forex, let's start with derivatives. I can bet you, the moment I would have started derivatives, your trust on the subject would have gone. Everything is unknown and it is not difficult. By the time we'll move, you'll see it is not difficult at all. Let me go by my own way because I have the experience of, because marks and the knowledge has to go. Once you're comfortable with your basics of the inter and the foundation and the subject, in the next 15-20 days you'll be very comfortable with the subject. Then any chapter you'll say I'll pick it up, because mathematics I have to start reading. This is beta is a mathematics I have to start reading. Even in the bond valuation there will be formulas of mathematics. Time value of money, for example, we have to start reading. Formula is something which you have to do, calculation you cannot avoid, but start reading them. So beta is a very important term we'll be using tomorrow itself. The chapter which will start, what chapter will start, we'll take a call tomorrow. Today I'm just doing a basic which will help me in all the chapters which comes out. Let's put down the notes below that. Break will take after that 10 minutes. Let me finish off this part. I'll take 10 minutes break after this. So let me finish off this part. What we have done, we can do that. Note. A very important term. Class is still 9. 5 minutes plus minus, it's still 9. First, beta of the market is so why beta of the market is 1? Because relationship with itself is 1. Same. Second, if the beta of the stock is greater than 1, if the beta of the stock is greater than 1, it is known as high beta stock. High beta stock or aggressive beta stock. high beta stock or aggressive beta stock. Instead of naming some of the companies, because there are n number of companies, I'll tell you the sectors which are high beta sectors. Infra, for example, cement, steel. So you can put down some of the example. These are some sectors are basically industries. What you call industries in the accountancy term, we call them as a sectors. So you can put down example here. Infra companies, particularly banking. Banking is financials basically. Banking, steel, cement, etc. These move very quickly up and very quickly down. So they are aggressive or high beta stock. Third, if the beta of stock is less than 1, less than 1, less than 1, it is known as low beta stock or defensive. If the beta of the stock is less than 1, it is known as low beta stock or defensive beta stock. Example could be pharma companies, for example, FMCG. FMCG is fast moving consumer good, for example, ITC and so on. Beta is a measure of systematic risk. It's a measure of systematic risk. Sir, what is systematic risk? Systematic is macro level risk which will impact everyone. Beta is a measure of systematic risk. Systematic risk is which will impact everyone. A very, very important term which comes out. Although in subsequent chapters we'll speak more on the systematic, unsystematic risk and so on. But formulas again will require some time which will come at an appropriate level. After that we have few more notes. Before that we'll take a break. 10 minutes break we'll take, energy nap, and then we start off. Let's start. We were discussing beta. Let's continue with beta only. Beta is a measure of a risk. I'll just put down one more hash note before we move to the next point. Put down higher beta is equal to higher risk. Lower beta higher beta is higher risk, lower beta is lower risk. The important word is risk. That's it. Risk is a fluctuation in finance. Risk is not a loss. Risk is fluctuation. Higher the fluctuation, higher would be the return expected. Lower the fluctuation, lower would be the return expected, which comes out. Next note number is what? This note number was what we have? This was ninth. Beta was what number? 9. 10th note number will put down. Going back to your IPCC cost of capital, methods to calculate KE. Methods to calculate cost of equity. There are a lot of methods. The broadly what we require, four methods. I'll do it here. First one, a very very important formula and chapter which you have done earlier also, and in CA final also will do it. That's dividend discount model. DDM, also known as dividend growth model. Dividend discount model, dividend growth model. Anyone who remembers the formula? K is equal to eh? Dividend by price. Very good. Somehow, sir, IPC is gone. D1 by price plus G. I'll not discuss much about this method today because we have a chapter on this. When we move to security valuation, shares valuation, we have this chapter. In fact, if you have done, there used to be dividends chapter also, Walter's method and Gordon, etc. D1 by price plus G. Actually, this is a price formula. Some part I want you to know. Price used to be D1 divided by K minus G. Sir, what was D1? D1 used to be dividend expected next year. Why this is called? I'll just give you a brief hint. I'm not discussing anything because we have to spend, I think, almost half a class or more than half a class on this formula itself. It's a perpetuity formula derivation I'll have to do at a final level so that we are able to make a sense mathematically out of it. It's d1 by k minus g. This represents why it is called dividend discount model is what is happening here. D1 divided by k minus g. This discounting. It's discounting back your dividends. Taking help of d1 dividend from this period till infinite means there is some formula which comes out which it is doing. We are not doing mathematical derivation here. We'll do it. Why it is called growth? Because g is involved. Growth is what will be the growth of the dividends going forward. What we need is the ke. We would be doing derivation of this formula. Automatically this formula would come into picture. As of now, not required. Purely a theoretical formula. Second formula what I'm writing is capital asset pricing model, KPM. The maybe if I say very frankly, only practical used formula, or the most used practical formula, that's KPM. Anywhere you will go, or any of the documentation what you see in the valuation or anywhere, you'll find this KPM formula calculation. A very very important, which I'll do in detail here itself. Capital asset pricing formula. Let's put on please second formula. KPM, a very important formula. Capital asset pricing model. So we have done this formula. Yes, you've done this formula. This formula was done in the inter. Formula put down please. KE. In fact, KE is interchangeably used word with RE, required return, and ER, expected. Again, I am not going into depth because there is a technical difference between RE, ER, and KE. Respective chapter will take it. In layman's language or for the purpose of examination, this is interchangeably used for KE, RE, and ER. Actually, this correct formula should have been RE, required return. But your institute and in theoretical level, we use it for KE purpose. So I'm writing it here KE. KE is equal to RF plus beta into RM minus RF. A very very important formula which we'll discuss in detail. K is equal to RF plus beta into, sir, RF stands for, RF is equal to risk free. Risk free rate of return. Beta is beta coefficient. RM, return from market. RM minus RF. Market risk free. MRP. MRP. RM minus RF. Now below this only, because these two formulas are very small, so I'm not writing here. We'll write the heading as a KPM only. I'll write the heading as a KPM. This is the formula which we need to discuss in detail. Let me try to analyze this formula, please. Sir, what we need to write here in these two left, third, and fourth formula, they're very small and simple. Almost theoretical formula, we don't require a lot of space. KPM is KE is equal to RF plus beta into RM minus RF. RF is risk-free rate of return. What is risk-free rate of return? In which technically we call it as no risk is involved. Practically, frankly speaking, in the world there is nothing called risk-free. There is nothing called risk-free. But when we talk about risk-free, if we are doing valuation in any particular company, let's suppose it's an Indian company and we are looking at the Indian perspective, the risk-free would be the safest instrument which will default at the last in the Indian economy, will take risk-free. For example, let's suppose PPF. If it is giving me 7.1 or 7.2 return, it might become my risk-free rate of return. That means that is the last instrument in an economy to default. Any economy can default, any government can default. So that means there is ideally no risk free. But for the purpose of this formula, if we are in India, we'll take the safest instrument of the government of India. If I'm doing the valuation in the US, I'll take the safest instrument of the US. So risk free is that return. That means risk free means there is no risk. If I use the word there is no risk, then beta of the risk free would be what? 0. Technically there is no risk. Although I'm saying practically there is risk involved, but for the purpose, if this formula was not assumed this way, then when we cannot create any kind of a valuation work. So beta of the risk free is basically 0. Beta of risk free is 0. That means this is the return I need if I am talking language now. This is the return I need if I do not take any risk. And from the perspective of the interview, if I'm saying this is the safest instrument of a particular economy, that means in a particular economy this is the last instrument to default. That's the risk free. If let's suppose I say India, 7.5 could be the risk free rate of return which comes. Beta we have just learned which comes out. Sir, what is RM? RM is return from market. RM is return from market. Market will learn roughly what it means, although not required. RM is return from market. Now you can stop writing for a minute to understand how this formula works. If you are able to speak in this formula will make lot of sense which comes out. I'm just taking few numbers, please. Let's suppose, do not copy anything. I'll dictate this as an example. Let's suppose RF is 10 percentage. RM is equal to 15 percentage. I'm trying to read this formula. Please do not copy anything. I'm trying to read this formula. It means is I need 10% return. I need 10% return when my risk is what? 0. What is the beta of the market? Beta of the market is 1. If the beta of the market is 1, we just wrote down beta of the market here. Beta of the market is what? 1. If I take 0 risk, my return expectation is what? 10 percentage. If I take risk equal to 1 beta, my return expected is what? 15. Now please do not copy. I'll dictate full example and then we'll do it. If I try to visualize this formula, I call it as I need 10% return without taking any risk. I need 10% return without taking any risk, plus I'm just putting beta here. I need 15% return at 1 beta. 10% return is at what? 0. That means if I visualize this here, it becomes what, sir? This becomes KPM equation. How this do we read? We read it as 10% return, beta is equal to 0, 5% extra return, 5% extra return when beta equal to what? 1. That means if the beta excess return from the market when the beta is equal to 1. Now let us put, you assume any company's beta. We said 1.2 beta. If at 1 beta I am asking for how much extra? 5. If 1.2, how much extra I'll ask? 5 is for 1. 1.2 I'll ask for how much excess return? 5 into 1.2 how much? 6. 10 anyhow I need. 5 I need extra when I move from 0 to 1. 5% extra. If the beta is high, risk is high, return expectation would be higher. That means 5 excess return when the beta of the market is equal to 1. If the beta is 1.2, I need how much extra return? 6%. My total return would be what? 16. What was the return from the market? 15. Market return 15 was at beta of 1. My beta becomes 1.2. My total return becomes what? 16. If sir your beta is 0.8, 5 at 1 at 0.8, 4. My total return becomes what? 14. Is my beta less than 1? Yes. At 1 beta, total return is how much? 15. At 0.8 becomes 14. It's called Kapam equation. Sir, how do we read RM minus RF? RM minus RF is excess return from the market when beta of the market is 1. When beta of the market is always 1. Excess return from the market. If beta is higher, means rough, basically you'll be able to make a sense out of it. The moment beta is more than 1, your total return would be more than RM. The beta less than 1, your total return would be less than RM, which comes out. And reading way is, I need 10 without taking any risk. I need extra 5 when I take a risk of 1. If I take risk more than 1, my return expectation is more. If I take risk less than 1, my return expectation would be less than 1, which comes out. Now let's do one thing. Define RM minus RF first, then I'll dictate this example. Let's put down how do we read RM minus RF. Let's put down this. Excess return from the market at beta of 1. Excess. Excess return from the market at beta of the 1. Now we can put down example here. RF is equal to 10 percentage, RM 15, beta I'm putting as 0, 0.8, 1, 1.5. Calculate K using Kapam. Now whenever you have to calculate K using Kapam, always first pick a Kapam equation. As per Kapam, let's put down K is equal to RF plus beta will remain variable, rest we can freeze. 10 percentage, beta leave as it is, 15 minus 10. This is known as Kapam equation. Now we can do what, sir? You can start putting, if beta is 0, put 0 in beta. If beta is 0.8, put accordingly, you'll get the answer. And always verify, the moment beta is more than 1, your return would be more than RM. The beta is less than 1, your return would be less than RM, which comes out. So now I can keep putting. My first part is beta 0. My answer would be 10. I am again saying correct terminology is RE, yet interchangeably using it. Do it for the 0.81 and 1.5. Second part, 14, 1.1. If beta is equal to 1, that means return from the stock would be equal to return from the market. Return from the market. A very, very important equation. Practically only used formula. Before I come back to the rest of the two formulas what I've written, I would like to draw this in the line which again will be using in the portfolio management. This can graphically we can draw and we call it as a security market line just for the purpose so that our beta concept comes theoretically in line. Below that only, no new number, below that only we can write security market line. Security SML. It is a graphical representation of KPM. It's a graphical representation of KPM. Now I'll draw. If you can draw straight lines, this is straight line only, whether you like it or not. Straight line, which comes out. You can before you copy, you can help me out. I'll put it as KE beta 0. At 0 beta, how much return do we expect? At 0 beta, how much return was there? 10. That means I need a minimum rate without taking any risk. It means this line will start above 0. I'll make this a starting point. It's a straight line like this. Before you copy, please help me out so that you should be able to read that out. That means at without taking any risk, I need how much return? 10. If I take some risk, my return what? If I take some risk, my return what? Increases. That means if I try to put it here, if beta becomes 0.8, my return was what? 14. 14%. Then my beta was what? 1. My return was what? 15. Then my beta was? My return was what? 17. This line is basically a security market line. This line, what you call it as. And if I technically call it as anything above this 1 is aggressive and below that 1 is a defensive which comes out. This graph should depict you very clearly one thing, that without taking any risk, why it is standing, it's a financial line. We'll be talking some statistical line also. Means for you it becomes the line only, sir, but you should be mathematically aware a financial line starting above 0 means that without taking any risk, I'm expecting some amount of a return, and as my risk increases, my return increases. Copy that down, please. K is interchangeably known as ER, expected return, RE, required return. Although we'll talk in detail when we move to the respective chapters. So no need to worry on that front, please. It's a graphical representation of KPM. This actually can come as a theory question in the portfolio. Plus, we'll do some more detail once we move to that chapter. It's a graphical representation of KPM. This line is a security market line, SML line. Starting above zero means it's a minimum rate of return at a zero risk I need. And as the risk increases, the return expectation increases. Sir, RE and these terms will be using going forward. There is a slight technical difference, but we use interchangeably. ER is expected return, RE is required return. Actually, KPM should give you RE. Correct is RE. If you practically go and someone is taking your interview and he says KPM helps in calculation of KE, ER or RE, your answer has to be RE. Required return. At our level, we can use interchangeably. Okay. Now let's come back to the graph. We'll come back. We'll come back to that phase we have left. Now, next two formulas are the theoretical formula and when to use, sir. If D1 is available or G is given, then dividend discount model. Whenever beta risk-free RM is given, we'll see in the questions, automatically KPM would be available. Now, there would be few places we'll get stuck. We do not know how to use a formula, what to use formula. In those cases, these next two formulas would come handy. Your institute uses them. Practically, we do not use them at all. Practically, this is the, if I say frankly, only used formula or the most used formula which comes out KPM. Let's put down third one, earnings yield. Earnings yield. Dividend yield formula was what? Price into 100. Try to create earnings yield formula. Earnings yield, earning is EPS divided by market price into 100. In fact, frankly speaking, this formula was also kind of a dividend yield only. A growth added. If growth was not there, this was dividend yield only. Similarly, earnings yield prima facie formula would be its EPS divided by what? Market price into 100. If growth is there, the formula will become similar to what? The dividend growth method. E1 divided by P plus G if it comes. This is means why I am telling you this is, remember these terms, you will be able to create formulas of your own. It's earning divided by price into 100. A very rare used, theoretically could be a possible, in exam it might be used. Earnings yield. If sir growth was there, then like D1 by P plus G, it would become E1 divided by P plus G, that formula comes out. Next formula, I do not have the name. I could have given the name as ICA only, but this is beautifully used by Institute of Chartered Accountants of India very smartly. KE is equal to 1 by PE ratio. 1 by PE ratio. You know how it works? P ratio is what? Price by EPS. This actually becomes what? Oh, this is this formula only. This your institute only uses. Please practically, I do not assume go and tell someone 1 by P ratio comes KE. Because this formula they use, hence this automatically becomes one of the formulas. How would you know? I'm telling you, when we'll do the questions, I'll be able to make a sense out of it. Which formula would be required at what place? We'll be able to do it. Copy that part, please. And interesting is, institute gives also in exam. Very recently also, I think they gave 1 by P ratio. This was what note number? 10. Next note 11. Again a very important term. These terms you have done in the inter IPCC, I'll be using throughout SFM, hence I'm covering today. Can I move forward? Next term, a very 11th formula, a very important again. Book value per share. Book value per share. Now, before I move to this formula and start dictating, you recall back MRF. What was the face value of MRF? 10 rupees. What was the share price of MRF? 99,000. What was the face value of C8? 10. Market price? 2000 something. Is that fine? Now let's, three things will use for difference between. What is the difference between face value and market price? What is the difference between face value and market price? In between comes book value. That means what is the difference in face value and book value? What is the difference between book value and the market price? This rough calculation will help you out in knowing exact again the valuation when we move forward. I am asking you, I'll take a, you can draw along with me a rough balance sheet of any company. Let's suppose any company, let's suppose Haldiram would have started, I'm just taking an example. Haldiram's is a chain of the food. It would have started with some sweets. Let's suppose when it started with 10 lakh rupees. Over the years, it has reserve surplus of 90 lakh. I'm asking about your accountancy now. 10 lakh share capital it started. Over the years, it has generated some 90 lakh in reserve surplus. Total becomes 100 lakh, 1 crore. Today you go to Haldiram's and ask him, sell your business to me. Will he sell to you at 100 lakh? Yes or no? Or he'll ask something extra. You have to do so much in accountancy. What you call that term in accountancy? Goodwill. No doubt on that. Now understand what I'm saying. I'll make you right, don't worry. That 10 lakh, let's suppose I made share capital 1 lakh into 10. 1 lakh into 10. 1 lakh is share outstanding, 10 is face value. Face value is 10, share capital becomes 10 lakh. If I add reserves and surplus 90 lakh, total becomes my book value. Total becomes what you call it as a equity shareholders fund also. Equity shareholders fund, that is exactly a book value. If I say that 100 lakh divided by number of equity shares, that becomes book value per share. Now that book value per share, difference between book value per share and share price is actually, you call it as a kind of a goodwill. In financial management, we call it as a future expectation, because when you say 110 rupees is face value, 100 rupees is book value, but price is trading at 150. Why that 50 extra? That is because if I have to sell my business today, I have generated brand also. My brand will keep giving you return for some period of a time. That basically is a future expectation which we would be calculating in subsequent chapters. So if I talk about MRF, 10 rupees is MRF. MRF was earning how much? 1924. C8 was earning approximately 51 rupees. Is that fine? Now think MRF every year earned 1900 rupees, was paying 150. Earning 1900, paying 150. Earning 1900, paying 150. The balance part gets added to what? Reserves and surplus. Book value increases. So face value plus book value increases. That book value plus future expectation becomes the share price. In the case of a C8, earning was less, so addition to reserve was less. Hence, difference between that book value and share price was less. Please understand what I'm saying. MRF 10 rupees, C8 is 10 rupees. MRF earning is 1900, payment was only 150. So every year approximately addition is 1800. So if you keep adding 1800 every year, your share price has to increase. Similarly, in the case of a C8, 10 rupees face value, 51 earning. Out of that 51, they were paying approximately 15-20 rupees as dividend. 30 rupees only gets added. So 10 plus 30 plus 30 plus 30 plus future expectation, the price comes out approximately 2000. So that is basically a face value plus reserves makes your book value. Book value plus future expectation makes a share price. How to calculate that future expectation, that we'll learn in the subsequent chapters. Let's put down please book value per share. I'll take a balance sheet, the numbers which I have just discussed with you. You can put down this same numbers balance sheet. Equity share capital, it's 10 lakh. Reserves and surplus 90 lakh. This total becomes 1 crore. This total becomes is 1 crore. This 1 crore is known as book value oblique equity shareholders fund. Equity shareholders fund. Now book value per share. Book value per share will be equal to book value divided by what? Share outstanding. Number of equity shares or shares outstanding. That will be 1 crore divided by 1 lakh. It comes out rupees. From this discussion, you should be very clear. If someone says, what is the difference in the book value and face value? Reserves and surplus. So I am just putting on the balance sheet this side. It's not the asset side. It's just I am putting for the purpose. Face value is what, rupees 10. Book value per share is rupees 100. Difference is nothing but reserves and surplus. If someone says, sir, why the share price is higher? It is future expectation. Sir, why are you emphasizing on that future expectation? The reason is, I'm again saying, when we talk about bullishness in the market, when the market are in the bullish trend, means increasing trend, the difference in the book value and share price would be higher. When market are a bearish or a downtrend, the difference between the book value and share price would be lower. Actually, to be very frank with you, market or share price is only because of demand and supply. Nothing else works. I'm saying again very frankly, please. Only demand and supply works. That means higher the demand, higher would be the price. And why the demand would be higher? Because you expect the economy would boom. For example, in property, what happens? In property, same thing happens. Think of a property. Let's suppose someone says a metro project will come near to this. Metro will come after 5, 10, 7 years. No one knows. But what happens? You know that property. The property prices jump. Exactly share market. Let's suppose I talk about today. Please do not buy it, or it's only again I'm saying it's only disclaimer. Remember the disclaimer. Idea. Let's suppose I say tomorrow or day after tomorrow news comes in. Promoter are putting in 5,000 crore, and some new equity investor is coming. He is putting in 10,000 crore. 7.8 rupees will become what in that single day? It should cross 10 rupees, I think, single day. Actually, that is a part of FNO derivatives. So there is no restriction. Idea can become double also in a single day. Idea can become 1 rupee also in a single day. If it is non-FNO, which will be a part of our derivatives, then they have a limit of increase decrease. But this does not have increase decrease. That means 8 rupees price can become 12, 13 rupees also. If by chance I would be very lucky enough because I use Idea phone, if funding comes in that, during your batch I'll show you that 7.8 should be a trading around 10.5 or 11 rupees. That could be possibility. And that not a small return. Maybe you're looking at 3 rupees. Just do 3 divided by 8. You'll get how much return which comes out. So what we call it as expectation is there. In fact, 3 days back I'm saying Wednesday or Thursday news came in. You go back and Google it out. Economic Times just put in news that 14,000 crore funding paper submitted. They can do anything. Newspaper, they're free. It's a free India. Same day, the 7.6 idea opens at 8.10 and move to 8.25. 7.6, 8.10 means almost a 10% jump which came out. BSC jumped very high. That means rumor. That rumor. Exactly same thing happens in the property market. If tomorrow someone says metro project is coming here, property markets will boom up. If I say there is a company in Hyderabad, HBL Power, please do not buy it again. HBL Power, it has already jumped 105 to 150. You know why it jumped? It's about a very sad event, but it jumped. A train accident happened. I do not read that accident happened, someone died and etc. It's very bad. But for me, it was important from the market's point of view. How important was market point of view? Because due to that, the kavach, there's something called kavach which can avoid rail accidents. These contracts would be given. When you go back today, those who do not have an attempt in this November, please, I expect you to read these kind of things. The price opened 112, opened 119, and in a week's time it is almost 145, 150, 154 it touched, I think. Because the assumption was the government will give kavach that contracts, and that company is in that kind of a business. These are expectations. So you don't require a rocket science to know what has to happen. Disclaimer is, please do not invest, but I want by the time we end our classes, subject is one thing which I am saying, leave it to me. But by the time we end our classes, you should be very learned enough to read a single news, good or bad. My news has to be from the economics point of view. I do not relate to anything. Please do not read that news. Oh, locker was looted, 3 people were killed, 4 gunned down. These kind of news destroy. Even the trade extent was not good. That was not good. Something which happened very sad. But I cannot help it out because of that company. The company, I by chance I invest also and I help investing also. It's separate thing. But that jumped up quickly. It happened, but that was not. It jumped. You should know the news could be good or bad for that particular company, how it comes in. So exactly same way I'm saying, if Idea, for example, or SML Isuzu or a JBA Moto, if any kind of a merger news comes in and so on, you have to keep checking those prices because that will be part of your valuations which comes out. So form a habit of reading any newspaper which comes at your home, only the business section. That business section comes just before the sports column in any newspaper. I'm saying not necessarily Economic Times or Business Standard. You have to read whatever newspaper comes, Hindi, English, Telugu, whatever language it comes, just open up a 2 pages just before that sports column, and I'm saying in a 7 8 days time you would be able to make a sense out of it. This is the event has happened, this is the impact on the company, this is the event happened, this is the impact of the company. So it is not necessary once you get the award then only price increases. The future expectation also increases that price, which happens. So in this case, if I try to link the book value per share, I'll say it as plus. In accountancy, you call it as goodwill. It's a rough term. In finance, we call it as a future expectations. We call it as a future expectation, and that basically becomes what? Share price. I'm just assuming rough number. Let's suppose share price is 220. I'm just assuming rough number. So why that 220? Because of the future expectation which comes. After today's class, few things I want you to be very comfortable. First, the formulas, what we have done. I'll just do a quick recap because I'll take 5 minutes more after that. So, because I've been talking market a lot. From today onwards, you should know when someone says market has gone up, gone down, what does it mean? Before we come back there, let's do a recap what we've done. Just flip over the pages, please. Quickly, we'll do a recap. We started with some terms to remember. Earning per share formula was earnings divided by number of equity shares. DPS, dividend, total dividend by number of equity shares. Third was payout, proportion of the earnings paid as a dividend, DPS by EPS into 100. Retention ratio, PS divided by EPS, proportion of the earnings retained in the business. Dividend rate with respect to face value. Dividend yield with respect to market price. Dividend divided by face value is dividend rate. Dividend divided by market price is dividend yield. P ratio, price by EPS. It's how do we read that? Let's suppose if I say P ratio is 40. How do you explain that 40? Approximately 40 years to pay back means earning. For example, in our MRF case, I think it came 52. It means if the price was 1900 and EPS was 1900, market price was 99,980. The P ratio came 51, 52 something. That means if I keep earning at the same pace, if I keep earning 1924, my investment would get recovered in what? 52 years. Or I can also say per rupee of investment, I need to invest how much? 52. If I need to earn 1924, it's simple. 1924 into 52, that gives me 99,980. That was there. Market capitalization, market price into number of equity shares outstanding, that came. Then we move to the beta. Beta shows relationship between simple terms stock and stock market. Stock market, I'll tell you what it means now. After that, if the beta is 1.2, it means market changes by 1, we will change by 1.2. Direction same or opposite? Positive beta, same. Negative beta, market beta is what? 1. Beta more than 1 is known as aggressive or high beta. Beta less than 1, defensive. Beta is a measure of a which type of risk? Systematic. It's a macroeconomic, will impact everyone. That was beta. Then we move to the beta of risk free is what? 0. That means I need this return without taking any kind of a risk. Then we moved methods to calculate KE. First was dividend growth method, D1 by P plus G. KPM was RF plus beta into RM minus RF. RM minus RF is a market risk premium. That means I need this much excess return at beta equal to 1. If the beta is more than 1, my return expectation would be higher. If beta is less than 1, return expectation would be lower. Offbeat formulas we call it as, which are rarely used, practically not used at all. Earning yield was EPS by EPS by market price, and KE formula can be used 1 by P ratio. Then we had done, I think, book value per share. Book value per share is book value divided by number of equity share. Book value is nothing but share capital plus reserves and surplus. It is as good as the equity shareholders fund. Total book value divided by number of equity shares gives me book value per share. Then came out face value and book value difference is what? Reserve surplus. You will recall back if you go to cost of capital when you used to calculate cost of retained earning. This concept you would be able to recall if you go back home today. And then roughly I'm saying book value and share price difference is nothing because of the future expectation. Practically I'm saying it again, market price would increase only with the expectation. If you expect this will happen in 7 years, for example, electric vehicles we are talking about. So when we talk about electric vehicles, it is not we'll wait for 6-7 years. Whichever company has taken the initiative, their prices have already jumped. Is that fine? That was there. Now I was talking to you about the market. This is a offbeat note, but yes, mentally it will help you out in my future chapter derivatives. Derivative is a part of a stock market, a very small part of a stock market. Now, when I say a market, please understand. I take 5-7 minutes more. This discussion, if someone wants to avoid, it's perfectly fine. They're free. Market is a stock market. In India, we have approximately maybe 35-36 stock exchanges. It is as good as a vegetable market. I'm saying vegetable market, I'll prove it. It's a purely, it used to be vegetable market. Now it has become online vegetable market, like you have big basket and so on. Popular two markets are NSE and BSE. National Stock Exchange came slightly later. It came, I think, in around 1993-94 somewhere. The oldest is Bombay Stock Exchange. We have Delhi Stock Exchange. We have Calcutta Stock Exchange. There is a Hyderabad Stock Exchange, which went bankrupt and they closed. I think this is closed till now. Where it is, sir? You know where it is, Hyderabad Stock Exchange? I'll tell you where it is. Now, those who are listening online, they might not know. It's perfectly fine. You know Tiwari's, Somajiguda, the Tiwari. From Tiwari, come towards Panjaguta. Come towards Panjaguta. Decathlon you've seen? Just opposite Decathlon, there is a petrol pump. Just beside that, it's Hyderabad Stock Exchange. Please, rest of you ignore. Those who understand, fine. My geography, na? Geography is bad. Tiwaris come to Panjaguta, Decathlon opposite Hyderabad. But interesting thing has happened. 2007, I think they went bankrupt. I don't know exact numbers. The land valuation had reached much more than what they have to pay. So they will again reopen or something. I don't know. But there are, what basically means there are a number of vegetable markets. Delhi Stock Exchange, Calcutta, but two popular are NSE and BSE. It's as good as I've taken the license to sell my things there. I can get myself listed in any of these stock exchanges. In BSE, approximately, why I call them a vegetable market, understand please. You know tomato? Tomato. Hindi tomato, English tomato, Telugu, you know. Potato. Tomato, potato, onion. These three are very common vegetables, very common. You'll find almost everywhere they're sold. Now, there could be some vegetables or some fruits which are very rarely seen or some markets seen. Name anyone you know. Any item which you think I only know, no one knows. Eh? Oh. Sitafal, what Sitafal is? It's commonly available, I don't know. May not be. Tomato, potato, onion are commonly available. Rest are not. Some could be non-commonly available. Non-commonly available. Jamun, for example, they're very costly. 350-500 rupees kg. Come some market. It's not everywhere sold. Limited stock. Let's suppose. Similarly, in NSE and BSE, there are a number of vegetables. BSE, I think you would find more than 4,000 securities being traded. Means more than 4,000 vegetables being sold and purchased could be there. NSE could be 2,200 and something. When we say market has gone up or gone down, please understand, it is not that everything has gone up or gone down. Sir, how is it possible? They have some 4,000 securities and this has some 2,200 securities, because it is not necessary that I am a company, I'm a very small company, my volume does not happen so much and my buyers are limited and sellers are limited. So I'll take the license, I'll pay the fees only to one exchange and I'll list myself there. It is as good as you want to list your product at different websites. You've listed at one of the websites. So there could be companies like Aknit, for example, or there could be Balu Forge, for example. These are of companies. They are only listed here, BSC. They do not are not available on NSE. It means if to buy and sell, you have to buy sell from this. It is not available here. Now the names which I took, Balu Forge or Aknit, for example, TI Global, for example, Magna Electrocast, you might not have heard these names. You might not have heard. For example, let's suppose I say, if you do not eat jamun, what will happen? Nothing will happen to you. If you do not eat sitafal or some costly grapes and so, nothing will happen to you. But if tomato, potato, onion prices fluctuates a lot, then everyone gets impacted. Even Aam Aadmi, and you will find a prime time news it becomes. Sir, why are you attaching the vegetables with the stocks? I'm attaching because when I took a name of the companies like Aknit, Balu Forge, TI, blah blah blah, you have not heard. Whether it happens, does not happen, does not make a difference to you. But if I say something has happened to Reliance, something has happened to ICICI Bank, something has happened to Axis Bank, for example, something has happened to Maruti. These are my tomato, potato, onion. English is difficult, na? Tomato, potato, onion. Now that means there are few companies by which everyone gets impacted and everyone knows. What I mean to tell you here is, in BSC, out of those approximately 4,000 companies, if I say, out of that, they have selected few companies. This is rough number I'm taking. There is slightly higher, then there are some suspended companies also. Out of that, they have selected 30 companies and they have put it in a basket, and they have named that basket as Sensex. It means these are those 30 companies which impacts everyone. Whenever the movement in those 30 companies comes, we'll say market has gone up or gone down. We'll say market, otherwise there is no impact on rest of them. Similarly, in NSE, out of all lot of companies, they have picked up 50 companies and named it as Nifty. It is a basically kind of a bag they have put. In bag, 50 companies they shuffle around. Some company go up, some company come down. Average of them, they find out at the end of the day whether they went up or went down. They call it as Nifty. When we say, whenever you hear market has gone up or gone down, it's basically this 50 and 30 movement which comes in. Sir, do they change? They change. They change. And these are companies which are very commonly known. If I try to show you this, let's suppose if I try to show you, this is Sensex. This is made of how many companies I said? 30. Total are not 30, total are n number of companies. If I try to click on Sensex, let's suppose these are the part of the Sensex. If you try to read them out and put 1, 1, 2, 3, 4, 5, 6, and below is 1, 2, 3, 4, 5. How many company becomes? 30. Try to read the name and look at the beauty of the Sensex it is made. Bajaj Finserv, Titan, Kotak Bank, HDFC, IndusInd, ITC, HDFC, Bajaj Finance, Hindustan Unilever, Reliance. They have company from NBFCs, banking sector, then Pharma, Sun Pharma, IT company, HCL, Infi, Steel, Tata Steel, Paints. They have the the auto sector. They have those companies. The green companies basically have taken up the market, and the red company basically have done what? Taken down the market. And if you look at, when we call it as, this is the close price 63,384, and the market went up by what? 466.8 means on Friday. This is a Friday close. Saturday, Sunday market remains closed. That means on Friday, Sensex went up by how much? 466 something. Now, when we call this as, this means this 466 is nothing but average movement of these 30 companies. Sir, then second doubt comes in. What about, I talked to you about one of the companies, Balu Food. This is latest on my radar. Please do not invest in it, just for the sake of understanding I'm taking. This was up by how much? 8. Does it have any contribution towards the Sensex? No. It might also happen tomorrow the market goes down and this company is up, or market go up, this company is down. It does not have any impact on the Sensex at all. If I try to look at the price, look at the month high and low. This is month, 5th column, 6th column. What was the low? 9. I cannot show you. This is 98. Can you see the 98? 98 here. Second last column. Or weekly, can you see? Weekly. In a week, it moved from what? 117 to 148. But this is not part of Sensex. This is independent of that. But is this company tradable in the BSE? Yes, it is not available in the NSE. One doubt should be very clear, please. All vegetables are not sold, and when we say something has gone up or gone down, because when my tomato, onion, potato becomes movement, na, it becomes a prime time news. Exactly, if something happens to Reliance tomorrow, something happens to Axis Bank tomorrow, or Maruti tomorrow, everyone would know something has happened. Everyone would know. Second doubt, which you should not get now, is sir, how to read this 63,384? You know how to read this? What is 63,000 Sensex means? It basically means is actually it's a base is, I think it's your homework today. Base is 1979. I think so. That means 100 rupees of 1979. If someone would have invested in today's term, they are what? 63,000 rupees. The market always goes up, and you will be very fascinated. Market always goes up, but market cheats us because they keep in those 30 companies only those companies which help them move up. If something becomes bad, they'll throw out. So market will always go up. We do not know your portfolio will go up or not. So please do not, as a student of finance, do not get mesmerized or happy. Oh, market always goes up. Market always gives return. Market gives a return. It gives. You can imagine 19,700 rupees now are what? 63,000. That's almost a 630 times which is there. But what they do is one of the earlier days, for example, Satyam used to be part of this, but it went out. Then could have been Adani stocks also could have been part of it. Adani's saga happened. They move out. If something happens to another company, they'll move out and fresh company then involve. So Sensex is managed very easily. But we should know if someone tells you tomorrow market has gone up, in a layman language, you should be able to tell it's average of, although average calculation is not so simple, but you can say average of those 30 companies has gone up. If someone says Nifty has gone, NSE market has gone up, only 50. Sir, can we see that NSE companies? We can quickly see that out. If I look at, and as a student of finance, you should be able to make a sense out of these. This is Nifty 50. Can you see that 18,826? Sir, why is it at 18 and that was 63? The base year of Nifty is different. I think base year of Nifty is 1995. Please go back and check. We can base year 1995, and I think it started with 1000. Base year of Nifty. These things I want to do it today. I'm just giving you help. Yes, you can see that the base year of index Nifty is what? 95, and it started with index value of what? 1000. So how do you read that 18,000 now? 1000 rupees of 1995 in today's terms are what? 18,000. That is how do we read. And sir, will these Nifty 50 companies would be almost same? There would be 30 companies similar. Rest there could be what? 20 more. So exactly same thing happens. So please, as a student of finance, after today's class, if someone says market is giving return, market only means is what? Market means only Nifty and Sensex. Out of all the listed companies, NSE has picked up how much? 50. Nifty 50. 50. Sensex is 30, which have come up. And base years, basically, how do we read 18,826? 1000 rupees of 1995 are 18,1826. If I look at, try to search that company Balu Forge here, you will not find anything, no record found. Now there could be possible, I have Espin Wall, for example, this one company. Is this company available in NSE? Yes, this will not be available in the BSE if I go. So basically what I mean is that you should be very clear cut, understand that there are companies which can Espin Wall, there is no match found. That means there could be possible some items are sold only in one stock exchange. The rest of the things has been moving because this was basically to give you a hint, because some of the students have doubt that how can I buy somewhere, how can I sell. At a student level, you will not do anything buy sell, no matter how much lucrative it becomes. But my advice is those who are not having a attempt at least for a 1 year time, please make your base so strong that when you enter the market, you do not sound, means I should not sound stupid that someone is talking about NSE, BSE, Nifty, Sensex, and I say, paper it was not there, question did not come. My objective is marks, I know, but at the end of 5 or 7 minutes, if I have the time, I'll discuss, otherwise I'll not discuss. But what is relevant for my subject, I'll discuss that, because I cannot do derivatives without touching the practical side of it. Practical does not mean that I have to do the trading only. I don't have to make you a trader, but I should know this data looks this, and seeing that I can frame a question, I can solve a question which comes out. So is that clear? Market what it means in tomorrow could be a historical day. Do watch. It might, we might see a new nifty high. When we come tomorrow, we'll speak on that. Few companies which fundamentally I want you to track over a period of a time. I let you know. Track fundamental means from their growth prospect, those especially not having attempt nearby. From their perspective, for example, what is the growth in the next 3 4 years, how the projections are there, how we can make the forecasted. For example, you make a cash flow statements, you can in your free time make the forecasted cash flow statements and so on, or if time permits. Otherwise, I'll just keep sending you, or we'll keep discussing few things if I find some news article that this news article came and this was the impact on the company, so that you are able to attach a particular news with the movement in that particular stock. Okay? And we'll wind up here. I think that's enough for the day. Tomorrow we'll start with the uh, in fact chapter, which I'll let you know. Books I think have reached Hyderabad. I think they are still in the transit. Tomorrow we'll have the books. No need to worry on that. Carry yourself. I told you, register different ink color pens and calculator. That's more than enough. It should be. Thank you. Take care. Bye bye.